Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, Head of UK Rate Strategy, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Okay, Giles, I'm going to start with you because I spent a lot of time last week talking about the inflation narrative and the outlook in the UK after we had that huge upside surprise on, both headline and core, what that meant for our inflation views, bank rate views, market views, et cetera, et cetera. And we've basically had the opposite now this week in the euro area. We've had a downside surprise, and that's what's been driving global markets. So let's start there. Is this really a turning point for euro area inflation, do you think?
Okay, well, the first thing I want to say is I'm not sure that it was the only thing driving.
Okay, not the only thing.
Yeah. And in fact, I think we could maybe come back to the slightly, what for me was a little bit of a confusing reaction, particularly in risk assets around the this resolution of apparent resolution of the debt ceiling, which we've been talking about a lot in previous podcasts, and I'm sure listeners are sick of hearing from everywhere. But anyway, to answer your question sort of reasonably directly, I mean, it certainly feels like it's a strong signal at the very least, right? We have had underlying inflation measures mostly continuing to accelerate in Europe up until very, very recently. And what we saw this week was, again, a significant divergence with the UK, because we had the BRC shop prices data, which accelerated further, I think, to, I want to say 9%, but maybe somebody will fact check me and call me out on that. But it was a very high number.
Not just the BRC shop price inflation, but the BOE's decision maker panel survey as well, which showed inflation expectations rising at the 1 year point and the 3 year point, just to throw that in there.
No, right. So look, I mean, maybe there's good news around the corner in the UK. We can come back to that as well. Maybe this is just something which plays through on a sort of rolling basis. But the numbers were clearly a lot better, and we started out with a little bit of a mix, and because we had Spain and Belgium, and the Belgian core index actually didn't fall. On the contrary, so a little bit more UK. Maybe it's close to the UK. I don't know. It's a lot. But Spain fell, the core in year-on-year rate fell from 6.6 to 6.1. And I actually, just looked at this seasonally adjusted series and worked out what the kind of, the annualized monthly rate of change is, if that makes sense to people. And, it seems like in Spain, at the very least, while we had an enormous ramp up in core prices in the first few months of this year, that's really fallen back to between sort of 0 and 1% in the last couple of months. So we don't have continuing momentum there. Spain's a little bit idiosyncratic. It dealt with its inflation shock driven by energy prices really quite early in this cycle, and so it wasn't clear that was going to play through in other countries, but it seems like it did. We had a fall in Italian inflation, moderate, but the core there dropped from 6.3 to 6.2. We had German inflation, French inflation, both down reasonably substantially. And if you look at the details, the services and non-energy industrial goods, those were all quite convincingly lower. So I take this pretty seriously, and I think it's likely to lead me to nudge down my Bund target. That doesn't mean I'm going to go bullish, because we're at about 2.3% or something like that for 10-year Bund. But whereas I was looking for something like 100 basis points higher than that. But I think I'll probably bring that down a little bit just to reflect the fact that this kind of data does matter. We've also been thinking quite a bit on the desk about the way to think about inflation more generally, and over this last week, kind of spurred actually by on my side. In fact, I'm looking up to see if Jan's going to listen to. But look, no, we've been sort of looking through some of the the more recent academic studies and trying to figure that talk about, okay, what was it that really drove inflation in 2022 in the dramatic fashion that it did. And it seems like the consensus is sort of pushing back towards theories that really emphasize the supply side rather than the demand side. And we know that the supply side story has dramatically improved: food, energy, supply bottlenecks, all those sorts of things. So maybe this is something that we should take seriously as a turning point.
So you mentioned what that will likely mean for your sort of Bund forecast and things like that. What about your ECB view? I guess we've long been at the more dovish end of certainly market pricing for a while. I suppose that feels vindicated now, and any other market views really.
No, absolutely. I mean, I don't have a lot to say on that. I think that our call for a peak in the ECB rate at 3.5% is tracking reasonably well in the wake of all of that new information. I would say still that the risks are on the upside. So we could get a follow-on rate hike in July or even later this year that would bring it up to 3.75%. But I think that the risks are that the ECB will feel the need to go much higher than that are clearly less now. So yeah, we're feeling pretty good about that.
I guess, well, in light of what you just say, then I probably know the answer to this, but given they were published not that long before we started recording this pod, I guess it would be prudent to just check that there was nothing interesting or of note in the ECB minutes this time around.
No, look, not especially. No, it's always a very, very long document and quite an unrewarding one to spend going through, and particularly on this occasion. The May update really was not. I mean, there wasn't a huge amount of new data. There wasn't a lot that had changed in the way that Hawks and Dove were telling us they saw that incoming data. I just want to say one other thing though, but which is that obviously the CPI data that we've just been through is the last really significant European data before the ECB next meets, and we think that the ECB is likely to bring down its inflation projections. So June is one of these quarterly forecast meetings, and so if they were to do that, then that would then set the tone, I think, for the whole sort of discussion coming out of the ECB over coming months. And so that would help our more dovish view, I think.
Okay, so before we move on to the US, and probably this is actually a nice segue into Jan anyway, but we talked at the beginning about European inflation being one driver of the rally, the global fixed income rally that we've seen this week. Of course, the other driver was this risk-off reaction that we had when a deal was reached over the weekend. The UK and the US were out on Monday, so there's a little bit of catch-up to be had on Tuesday, and that has really mostly followed through all week. Does that make sense to you, Giles? I'll ask you that first, and then Jan, perhaps we can bring you in and talk about, what really has been agreed with the debt ceiling and what's next, etc. But let's talk about the market reaction first.
No, I don't think it does, and so that's been something I've been scratching my head about all week, and it kind of flies in the face of the dynamics that we saw in the period up to last weekend. And I certainly would have. No, I can understand. It's not necessarily what I would have expected, but I can certainly understand that that this has released pent-up demand for treasuries. So maybe that could explain the demand for bonds and the rally in rates. But I find it confusing that it's coincided with actually a period of weakness in risk assets when you would have, all else equal, expected the opposite. So, what does that mean? It makes me a little bit concerned that then perhaps we might have a bit of a risk-on correction to come.
Okay, let's see. Jan, over to you then. Well, like I said, anyone who's listening to this should already know that we're basically there now on a debt ceiling deal, just going through the final voting process. What implications does this have going forwards? I guess really I'm thinking about the supply outlook here and how you're thinking about treasuries going forwards in light of that reaction that we've seen this week.
Like you said, it appears that a deal is more or less done. By the time this is released, we might actually have a final vote, and the president might have signed the bill. A couple of interesting things from the debt ceiling or the resolution thereof. Markets did rally, at least in like fixed income space, across the curve on the announcement of that a deal was reached earlier in this week. That could have been just a built up of slowly and gradually. Like markets were anticipating a deal to be struck over the weekend, perhaps, but every time there was discussions of, the politicians getting closer and closer, fixed income did sell off. It's hard to exactly attribute how much it was, how much the sell-off of last week was on the back of data or more hawkish Fed speakers, or in anticipation that a deal is coming. In any case, after the actual announcement was made, fixed income did perform very, very well early in the week, and it still has. It's been a continuous rally since Tuesday, at least in the U.S. So it kind of became, I think, one of those like buy the rumor, sell the fact type of, or I guess vice versa in fixed income, fixed income's case, situations. So what does that mean for supply? Now everyone is focused on how Treasury is going to go ahead and replenish its Treasury General account, the so-called TGA, which is basically the Treasury's checking account that sits at the Fed. That has fallen to a pretty low level. Treasury's target is to bring it to 550 by the end of June and 600 billion by the end of September. So that more or less implies, incorporating our deficit estimates, we think about 650 billion of net Treasury bill issuance over the span of the next 3.5 months until really until September, mid-September, I would say. And from there on, another 150 until year end. So call it 800 billion from now until the end of this calendar year in bill supply. That's a substantial amount. It will certainly push the amount of Treasury bills outstanding as percentage of total marketable debt to its higher part of the 15 to 20% range that Treasury tends to operate in these days. But main implications should be for money markets. That will keep cash products, in our view, cheap compared to the corresponding SOFR swap rates. We do think that the excessive overvaluation in Treasury bill space on the back of very, very strong demand for short-dated collateral is more or less gone. We should expect to see them trading in a much tighter range compared to the corresponding SOFR swaps. So as far as further out the curve, if we're talking like 5, 10, 30, it shouldn't really be that impactful for duration. I mean, supply in the U.S. tends to be pretty well absorbed, and there is still a decent amount, over $2 trillion at the Fed's RRP facility, which in our view will be the main way that this new issuance will be absorbed. Money market funds are now, and the money market funds are the main users of the Fed's facility. They are at A, historically very low weighted average maturity of their portfolios. B, they now more or less received a sign that the Fed is, well, in our view, the Fed is not hiking, or at least very close to it in any case. And C, they will be willing to extend a little bit more duration in this circumstance. So we think the supply will be pretty well absorbed, but the focus has been on how much is going to come. I think from what I've seen in news, we are probably a little bit on the lower end of estimates. I've seen expectations north of 1 trillion as well until the end of the year, but we think those are pretty optimistic on supply.
Okay, I want to pick up then on what you said about the Fed, because that's obviously been, the other main theme I would say this week, that certainly on the US side, this narrative of pause hike has kind of been picking up pace. It feels a little bit in some circumstance, or in some instances, like a bit of a coordinated communication effort, you might say, to sort of feed that message to the market that they may well pause at the next meeting, but indicate that a hike is coming further down the line. How, we discussed this a little bit with Kevin last week, but obviously there's been a flurry of data since then, and we'll also have jobs data tomorrow. And so how do you expect that to play out? What kind of number would we need to see on NFPs that might force their hand in either direction? And how does that sit really versus what your base case is in light of all the data that we have had this week?
Yeah, I'd say the Fed was an important topic, not just this week, but maybe
maybe every week. All right.
But yeah, NFPs tomorrow, the non-farm payrolls tomorrow will likely be the determinant in whether the Fed goes or no. But we think the bar is actually not very low. I mean, we would need to see a meaningful kind of acceleration there. Let's just say get a number like 350,000, right? That's a pretty big gain in jobs for a month. And yeah, that probably tips the balance towards hiking. The Fed will get CPI the first day of the meeting, but we think that might be a little bit too late to react to. And instead, if we get a weak jobs, and a stronger CPI, what they can do instead is don't hike in June and adjust their forecast. So they will be releasing their rate expectations too. So adjust the so-called dogs to show an additional hike for this year, which would imply that July is in play. We don't expect a hike in June, and we did see this week from Governor Jefferson, who's on his way to become the vice chair. He's pretty in line with that idea that a June pause is what's the right move, and that doesn't mean that the Fed is actually done hiking. In our view, if they do pause in June, the bar to restart hikes in July is pretty high, actually. But what I see it is the Fed probably doesn't want the markets to price in too much in cuts, right? So when you go ahead and leave that optionality, you sort of clip away the markets a bit to completely and immediately expect rate cuts in the very near-term horizon, which should prevent the very front end of the curve kind of inverting any further to a certain extent. I don't know how successful it will be, but my guess is that's kind of like the driving idea behind why they open the door for future hikes. I mean, of course, inflation could be accelerate too, but just very quickly on how much jobs matter going forward for the Fed too, and back to what Giles mentioned about all of that research that's been coming out on how much, well, maybe wages are not driving so much inflation as much, or at least as much as they thought in the past. And I think I agree with the Fed there. I think what's building in the behind the scenes is this push by the Fed that, well, maybe actually wages are not driving that much of inflation. I'm not saying nothing, but maybe it's not the main force of what we've seen. Maybe it's all these supply side issues that have been causing and the kind of the mismatches within the economy that we had from closing down, reopening. So what does that mean going forward? Well, maybe they don't have to completely destroy the jobs market for inflation to go back to target, and they can kind of achieve this normalization of inflation back to track without really seeing unemployment with very, very high figures. We talk to a lot of clients who will say, oh, well, the Fed can't really cut until unemployment gets to 5%, right? So that's not our view, and the Fed might be able to push that narrative that they don't have to wait for unemployment to go very, very high before they kind of adjust rates lower. And we've seen a lot of research coming from local Feds on that topic over the past month. We've seen, kind of Powell alluded a little bit towards, and at the Brookings speech he gave or dialogue, I guess he had with Ben Bernanke. So we'll see. That's kind of, I think, something that's brewing in the background and might kind of lower the bar for the future Fed pivot. I'm going to stop there for now.
Well, I mean, I'll just follow on by saying that actually we're trying to apply some of that research because there's reasonably simple models to the European case. So maybe that could be a topic of conversation, assuming we are successful for next week. But anyway, it's over to you now, Imogen. Talk a little bit about what's been going on in the UK, where basically gilts have actually been doing surprisingly well. I would say, at least surprisingly to me. But I would like to hear what you're thinking about that. It looks like we'll end up lower on the week.
Yeah, I think it serves me right for patting myself on the back too much for reaching the target last week.
More.
Yeah. You're right. I mean, it has been kind of surprising, not least because the drivers of the rally that we've seen, as we've just discussed, have really come from elsewhere. It's been about the US, it's been about debt ceiling negotiations, and it's been about European inflation, which, as we've discussed, looks to be on a very different track to the UK. In fact, the evidence that we have this week, like you said, the BRC, the DMP, the decision maker panel, all of those pointed to quite a different inflation narrative in the UK. But nonetheless, we've had this sort of global fixed income rally and gilts outperform. That has led, well, anyway, I think given the levels that we got to last week, but then certainly the very quick turnaround has led to a bit of a discussion on the desk, but also, frequently amongst clients about whether this is now the right time to get long, and maybe gilts did reach their peak last week. So I just wanted to run through, I guess, a quick list of the reasons that we keep getting why people think that they should be going long and why we think that they're perhaps not right to think about it in that way. The first is just that they look cheap outright and cross market. We already knew that. I've talked about this a lot of the time on the pod, but the fact that if we're looking at the kind of outright cheapening that we've seen, or the cheapening that we've seen on a cross market basis versus, what historically that level has been like over the last couple of years, then, leaving aside obviously the September and October volatility of last year, yes, gilts do look cheap, but that doesn't take into account the kind of major shift on the supply front. And then actually, if you're thinking about, at what level gilts are cheap versus previous history, you're probably underestimating the extent to which they can underperform further, because you're just calibrating those numbers on a completely different supply regime, which, as we've learned over the last couple of months, does matter. The fact that they were closing in on kind of last year's highs, those sort of post mini budget levels, although, I'll come back to this, but although we don't particularly think that this is going to be a repeat of last year, I don't think that necessarily all investors and all market participants will be confident in that. Certainly those that perhaps weren't familiar with what was really driving the move and the issues last year. And so actually getting to those cheap levels, conversely, may not drive demand, but actually drive investors further away, because they worry that there could be a repeat of last year's volatility. I think I talked about this last week, but the fact that, LDI, the pension community in the UK, won't be forced sellers. As I just said, we don't expect this to be a repeat of last year, but then therefore, is that a reason to be buying? Because you won't be getting the forced selling that we saw last year, which I think is a bit of a weak argument to be long, really. Just because you don't see forced selling is not necessarily a reason to start buying. I think you can probably think of that more as a cap on how much higher yields go, rather than a significant kind of downward force or a trigger for a rally. We're seeing a lot of, in the data, we had a new release of this today, which shows continued buying from the domestic private sector in the UK. And in fact, nearly all of that buying is kind of offsetting the sales that we've seen on the year from overseas investors. We've talked a lot about the natural buyers of gilts, i.e. LDI, pension funds, and overseas investors being very absent this year, and actually, being sellers of gilts. But we've kind of seen this increase in demand from marginal sectors like the domestic private sector, which is true. We can see that in the data, but I think it's worth remembering that while that's not necessarily a supply-demand mismatch, that probably is a duration mismatch, because a lot of that private sector demand will be focused at the front end of the curve, whereas a lot of the demand that it's replacing from the natural buyers will be much more at the longer end of the curve. So that's kind of gives another impetus to further curve steepening, we think. We're seeing reports of pickup in kind of retail household investment. The data on this, on households specifically, is a bit lagged. We only have it up to Q4 2022, so it obviously doesn't capture the kind of latest cheapening. But certainly anecdotally, I would say that almost every meeting I go to, we have people asking why isn't everyone buying gilts PA, given that they offer a capital gains tax exemption? And that's a huge topic of conversation is people asking us why more people aren't buying them. So I do think that there has been a pickup in retail investment of gilts. We saw the FT last week report, for example, AJ Bell saying that they were seeing kind of record buying from retail, from households. But it's important to remember that households own a tiny proportion of the gilt market. We're talking significantly less than 1% here. So even a very big increase on that very, very small number does not offset the usual demand flows that we would see from pension funds and overseas investors as well. And again, that demand is more likely to be focused at the front end of the curve. So you still have that duration mismatch. This is a bit long-winded to go through on the pod, so I'd recommend anyone who wants to push me on this further reach out. But we're also hearing questions around whether there might be potential rule changes around encouraging insurance funds to be bigger buyers of gilts than they are now. So that could replace some of the lost pension demand. I'll just say in short that we don't think that that's very likely, nor would that necessarily have the desired effect of increasing demand for gilts. So I don't see that as a huge trigger for going long. And then finally, just thinking about the inflation outlook, I talked a lot last week about how the natural buyers of gilts that we really need to return to the market to backstop yields and take down the rest of this supply won't return until they have confidence that inflation is on a kind of convincingly downward trajectory. And like I say, the evidence this week again points in an opposite direction to what we're seeing elsewhere in the Euro area and the US. But there has been or certainly we've been involved in discussions this week around, price caps in supermarkets that were in the weekend press, whether they will work and how effective they might be. And perhaps, the introduction of those might help in sort of bringing some confidence that inflation will be coming down. Again, I won't sort of go into detail in our views here, but I'll just kind of answer that in short to say that I'm not convinced that necessarily putting price caps, even though I think that in itself is unlikely, enforcing price caps on essential goods necessarily brings down the price of other non-essential goods, and therefore may well not have the desired effect on inflation and bring back that demand. So I guess that was a long-winded way of saying that I'm a bit confused by the rally, and I think that there's still further to go in yields. And I think I said this last week, but we have revised up our 10-year gilt target to 4.6. Of course, we don't expect that to happen immediately. It's much more of a gradual shift, but we do expect that to get there. And all the same drivers that we've talked about before. I guess the only other thing that I didn't mention was that we also had the supply calendar this week for Q2. There weren't any major surprises in there, but just to say that, again, that highlighted, the scale of duration that's still to be issued to the market. There's confirmed that we are going to have that link of syndication in July. We've got 2 long auctions and 2 medium auctions. So there's plenty of duration that the market will be left to take down in potentially quieter summer months.
Okay, thanks very much. I guess that the other question I had was just around Bank of England speak, which it hasn't been a particularly vintage week for, but Catherine Mann had a speech, or no, she was on a panel, wasn't she? And she noted pointedly, perhaps, and this is one I want to get your opinion on, didn't talk up the likelihood or her view that we should be raising rates at 50 basis point pace. What do you think about that?
So actually this week and even next week is pretty quiet for BOE speak. So the market's sort of lacking a little bit of direction now when it comes to BOE communication. And then, of course, we will very quickly be into the quiet period. But we did have Mann, you're right. Now, we know that she is the most hawkish member of the committee. So in some ways, we can kind of dismiss her views as being a hawkish outlier. But she's also a useful backmarker for what the most hawkish view on the committee is. So there was a little bit of chatter this week about the fact that, as you say, she kind of didn't explicitly put 50 back on the table, and that being a dovish signal. Now, it's our base case anyway that they do 25. I think that Mann could easily be a 50 voter, but I don't think that you get a majority of votes for 50 bits. I think they would much prefer to do a series of 25 bit hikes. And actually, I think Haskell, who's probably one of the other more hawkish members of the committee last week was indicative of that it was more likely a series of 25s rather than, 1 or 2 50s. But nonetheless, I don't read all that much into the fact that Mann didn't explicitly, signal her intention to vote for 50 or even put it back on the table. As you said, Giles, she was on a panel, so she wasn't really necessarily given the opportunity to say that. No one really asked the question directly, but she did talk a lot about, this difference between headline inflation coming off because of energy base effect, but still that persistence in core. She talked about the different situation that we're seeing now in the UK with that persistence in core versus everywhere else. And, I think she was as hawkish as you might have expected her to be. So I don't know that she really needed to put 50 on the table for that to be a kind of serious possibility that she votes for it. But in any case, we don't think that they do 50, so perhaps irrelevant.
I can't say though, Imogen, if you'd been on a panel, you wouldn't have missed the opportunity to remind everyone about your gilt target.
I don't think there's anyone I've spoken to this week that has not been reminded of my gilt target, so I'll take that. Right. I think that's probably enough on the UK, given that it was a bit of a backseat driver this week. Let's catch up next week, Giles. I'll hold you to that inflation discussion next week. And lots more things to think about. Thank you both for joining me, and thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.